let's talk about the Laffer curve. And the Laffer curve simply is based on these two insights. When you have high tax rates, that discourages people from earning and reporting income. And that means less taxable income. So when you want to try to determine whether a change in taxes is going to increase or reduce revenue to the government, you have to, in effect, measure two different things. Well, how much is the tax rate changing? And then how much is taxable income changing as a result? See, the reason I'm saying this is because politicians oftentimes have a very simple concept. If we double taxes, we'll double revenue. Well, that doesn't make sense. Imagine that your job was to run a restaurant and your restaurant sold pizza. I assume everyone likes pizza, so that's a good example. Well, if you were selling pizza in your restaurant, if you doubled the price of pizza, would you double your revenue? Almost certainly not, because people would look at the price going up and they would decide, well, I'm not going to eat pizza anymore, or at least I'm not going to eat pizza at your restaurant. Maybe I'll eat at home. Maybe I'll buy pizza from another pizza restaurant. Maybe I'll go to a restaurant that serves lamb or chicken instead. So in the real world, people with common sense understand you don't get twice as much of something, of revenue, when you double the price of something. But many politicians think that we double taxes, which of course is the price of working and things like that. They think if we double tax rates, we'll double tax revenue. And that's not right. Now, when you put this in a graphical form, this is what it looks like. At a 0% tax rate, that's the horizontal axis. At a 0% tax rate, how much money does the government collect? Zero. But at a 100% tax rate, how much money does the government collect? Well, if the government's going to steal every single bit of your money, you're probably not going to work. So the government's going to collect zero at a 100% tax rate. There might be some genetic communists out there who will still work. So maybe it's not zero revenue, but obviously at a 100% tax rate, the revenue for the government is going to be very, very low, because nobody with any sense, nobody logically is going to work in that kind of environment. And so between a 0% tax rate and a 100% tax rate, you're going to have a curve. Now, every economist, even very left-wing economists, agree that there's a Laffer curve. Where economists debate and disagree is on the shape of the curve. So I've drawn a curve that shows the revenue maximizing point at maybe 30%. Other economists might draw a curve with a revenue maximizing rate of 60%. That's the disagreement. Everyone agrees on the concept. We disagree on the specifics. But here's what I would try to point out. I have never worried about trying to maximize revenue for government. The revenue maximizing point is obviously the highest point of the curve. And maybe it's 30%, maybe it's 20%, maybe it's 60%. But that doesn't matter to me, and I hope it doesn't matter to you, because we shouldn't be at the revenue maximizing point. We should be at the growth maximizing point. And the growth maximizing point of the Laffer curve is where you raise enough money to finance the legitimate functions of government, a court system, the rule of law, maybe some basic infrastructure. We'll talk about this in my second lecture about the economics of government spending, but I'm simply trying to get across the point that the growth maximizing point of the Laffer curve is going to be much farther to the left than the revenue maximizing point of the Laffer curve. Now, one of the reasons that the Laffer curve became a big issue is because back in the 1960s and 1970s, many countries, including the United States, had very high tax rates. The central government in the United States, back in the 1970s, the top tax rate was 70%. And then, of course, you had state income taxes in many states and things like that. So we had a very high tax rate, and Art Laffer and other people were making the point that tax rate is so high that you're probably on the right side of the curve. What's labeled here, the region of declining revenue. Now, that's obviously the very worst place to be, because even if you believe in big government, even if you are a socialist and you want government to do lots of things and spend lots of money and redistribute a lot, uh, you know, it's foolish to have tax rates so high that you have less revenue coming into government. And so when we had the 70% tax rate in the United States, Art Laffer and other people were saying we need to lower the tax rate, not only to help the economy grow faster, but they even argued that you would get more revenue for the government. And what happened during the Reagan years? When Reagan followed this advice, Reagan lowered the top tax rate for the central government from 70% to 28%. Now, this, of course, were the tax rates applying to the rich. So the 70% tax rate was for people making over $200,000 a year, things like that. You might have had a 50% tax rate for a middle-class person and maybe a 20% tax rate for a low-income person. Reagan lowered tax rates for everybody. It was an across-the-board tax rate reduction. But I want to specifically deal with what happened when he lowered the top tax rate on the rich, because many of my left-wing friends were saying that's unfair. The government will collect less revenue. Rich people won't pay enough money to the government. And so, in effect, we had an experiment. We had an economic science experiment in the 1980s. And I want to show you what happened with that experiment. Well, first, before I even show you that experiment, I want to give you a couple of quotes. This is President John F. Kennedy, a Democrat, who lowered tax rates just like Reagan. And he made the point that if you read the quote, that when tax rates are too high and revenues are too low, the soundest way to raise revenues in the long run is to cut the rates. And why? Because you make the economy more prosperous. Here's Andrew Mellon, who was the Treasury Secretary back in the 1920s in America, when we also had big tax rate reductions. And he made the point that when tax rates are excessive, taxpayers withdraw their capital from productive businesses and the government gets no revenue. And of course, he made the point that nor is there profit to the people. Because I frankly care more about prosperity for people than I care about revenue for government, but it's a really dumb idea to have tax rates so high that the economy is hurt and the government doesn't get revenue. And then there was a scholar from the Ottoman Empire way back in is either the 1300s or 1400s, I think, who makes the point that when you get with small assessments, in other words, low tax rates, you get a large revenue, but if governments continue to do the wrong thing, they impose large assessments or high tax rates, and they get little revenue. So that's just some additional theoretical analysis of the Laffer curve. Now let's look at this experiment from the 1980s that I talked about. Every year, our tax authority in the United States, the Internal Revenue Service, publishes a document called the Statistics of Income Bulletin. And in that bulletin, you can look at how much taxes are paid by people at different levels of income. You can look at where the sources of their income are. You can look at what deductions and credits and exemptions they utilize. So it's a very thorough set of data. And I went to the 1980 Statistics of Income Bulletin, and I looked up how many people were making more than $200,000 a year, or how many households technically. And there were almost 117,000 of these rich people back in 1980. And in that year, they reported $36 billion of income to the IRS, and the central government, the IRS, collected $19 billion of tax. Now, this is when the tax rate was 70%. Ronald Reagan, in his 8 years as president, lowered the top tax rate to 28%. So the tax rate on the rich came down dramatically. And again, my left-wing friends said that's not fair. The government won't get revenue. The rich won't pay enough. Well, if we go to the 1988 Statistics of Income Bulletin, we can actually see what happened for people making more than $200,000 a year. And what happened? All of a sudden, there were a lot more rich people. They earned and reported nearly 10 times as much income, and the government collected nearly 5 times as much revenue. In other words, this is an example of the Laffer curve on steroids. Now, I want to be fair. There were other things happening in the 1980s that would have made the economy grow faster. Reagan reduced the burden of government spending. Reagan deregulated. We got control of inflation. There were lots of good economic policies in the 1980s that probably would have led to more rich people, more taxable income. But when tax revenues increase by 500%, there's obviously a Laffer curve effect going on there. So I think this is a really powerful example of why you want to keep tax rates low, not high. In other words, some of the politicians who pursue class warfare tax policy, they're actually hurting themselves because they want tax rates to be so high that they won't even get rich people to pay taxes that they can then use to try to redistribute and try to buy votes and do the things that politicians try to do. So that's one example. Now let me look at all of the developed countries of the world. This is data from the Organization for Economic Cooperation and Development. And I looked at the tax rates on basically countries from North America, the Pacific Rim, Japan, Australia, New Zealand, South Korea, as well as Western Europe. And in 1980, on the left, you can see in the blue bar that the average top tax rate was about 67, 68%. And you can see on the right side of the screen that the average corporate tax rate was about 48%. By 2018, which is the last year we have good data, the top personal tax rate is down closer to 42%, and the corporate income tax rate has dropped by more than half to about 23%. So in other words, keep this in mind, since 1980, we've had big reductions in the tax rate on income and profits. What happened to tax revenue on income and profits? And again, all this data is from the OECD, and the OECD is actually a more of a left-wing international bureaucracy. So they're not trying to make libertarian arguments, but they do have good data. So tax rates have fallen dramatically since 1980. What happened to tax revenue from income and profits? It went up. It went up from about 12% of GDP to almost 14% of GDP. And keep in mind that GDP grew. So government got a bigger slice of a bigger pie. In other words, it's so important to keep tax rates reasonable if you want to have good tax revenue collections. Now, again, I want to make another statement here. I don't want government to have lots of revenue. I believe in small government, but I'm sharing this empirical data with you to show that class warfare tax rates, high tax rates of 40, 50, 60, 70% on people, high corporate tax rates of 30, 40, 50% on companies, those policies backfire. Governments actually get less revenue. Now, from an economic growth perspective, again, I don't care about the revenue for government. I simply care about keeping tax rates low so there are more jobs, more opportunity, more entrepreneurship. But again, when you're talking about the Laffer curve, we're often dealing with a situation where governments are being so greedy that they put tax rates so high that it's self-defeating. Let's look at a couple of other things. Here's a chart from an IMF study. So we already looked at some data from the OECD. Here's another international bureaucracy. And it shows that corporate tax rates have come down. That's the blue line. And the reddish maroon line is tax revenue. And you can see that that's actually gone up. So the OECD and the IMF are both left-wing international bureaucracies. They oftentimes are saying, oh, we like higher tax rates, but the actual data that these bureaucracies produce show that you actually get more revenue when tax rates are low. Here's a chart from a study that was done by two economists, one from the University of Chicago and one from the Federal Reserve, which is our central bank in the United States. And it shows the estimates for the Laffer curve in both the United States and Western European countries. Now, I share this chart, and this is for labor taxes. I'll show you another one for capital taxes. I share this chart because you can see that they estimate that the revenue maximizing Laffer curve has a higher tax rate than what I showed earlier. I put it at about 30%, and they're putting it, well, depending on whether you're including human capital, they're putting it between 40% and 60%. But the reason I'm sharing this chart is I want to make a point that I think most people don't understand. Let's look at the dashed lines, because the dashed lines are the ones that actually measure the impact of tax rates when you include human capital. In other words, what is human capital? It's things like your incentive to get educated. Why do you get educated? You get educated, well, hopefully because you like knowledge, but also you get educated because it makes it possible for you to earn more income in your life. Well, what's your incentive to get educated? If the government's going to impose high tax rates on you for earning more income, you might have less incentive to educate yourself. In other words, to build your human capital. So let's look at these dashed lines. And look at, say, the blue line for the United States. You can see that if you have a tax rate of about 20%, your tax revenue is going to be about at the level of 100 in this index. If you raise your tax rate to about 40%, your revenues go to 110. But what's going on there, you'll notice that revenue is going up only a little bit, about 10%, when the tax rate is in effect from going from 20 to 40, it's doubling. So think about that. Politicians, if they double the tax rate, they only get about 10% more revenue. Now, think about what that means. It basically means that politicians are going to punish the private economy by doubling tax rates. They'll only get 10% less revenue, but that implies if you double the tax rate and you only get 10% more revenue, it implies that you're destroying a lot of private income. So in effect, what the politicians are choosing in this example, and this is based on empirical research on actual human behavior, if politicians increase the tax rate from 20% to 40%, they're going to destroy $10 to $20 of private income for every dollar of additional revenue they get. Is that a good idea? Is it a good idea to make your economy $10 to $20 poorer in order for politicians to have $1 of additional revenue? Obviously, the answer is no. So this is their estimate for labor taxes, and this is their estimate for capital taxes. And this example is even more dramatic because you'll notice that the curve is flatter. So in other words, every time politicians increase the tax rate, the revenue they get, even on the left side of the curve, the additional revenue they get is going to be very small compared to the amount of private economic activity they destroy. And so what I'm really trying to do here is to help explain to you why you don't want to be on the revenue maximizing point on the curve. Because if you're on the revenue maximizing point on the curve, it implies that you are destroying so much private economic activity, you are reducing private income in the economy so much that your higher tax rate doesn't collect any additional revenue. So it makes no sense economically. If you care about the prosperity of people, it makes no sense to be at the revenue maximizing point at the curve. You want to be at the growth maximizing point at the curve, which of course is much lower. So that's a complicated curve. It involves these concepts like human capital, labor taxation, capital taxation. But hopefully I explained it well enough that you understand that you don't want to maximize revenue for politicians, because when you're maximizing revenue for politicians, you are doing so much damage to your private economy that people, for every dollar the government gets, people will lose $5 to $10, or even in some cases $15 to $20 of income. I'm going to begin to wrap up here so we have time for Q&A. But I want to share a poll. I spoke a few years ago at a conference, a convention of certified public accountants who work on taxes. These are like the people who calculate taxes for companies and for businesses and for entrepreneurs and investors. And I asked them, and they actually did an online poll at the convention so that they could give their answers. And I asked them what their thoughts were on the Laffer curve. And you can see the 4 different options they had to answer. And again, CPAs, these are probably not people who are libertarians. They're just people who are professionals who do taxes, especially complicated taxes for investors, entrepreneurs, and businesses. And a plurality, more than 35% of these accountant experts said that lower tax rates would actually pay for themselves. In other words, they believed that we were on the wrong side of the Laffer curve, the right side where the curve slopes downward. So they believe that if you lower tax rates, the government actually loses no revenue. And then you had about 23% of them say that, okay, you might lose some revenue, but it would be very little because there'd be a lot of revenue feedback. And then about 18% of them said there'd be some revenue feedback, and only 15% of them, actually a little bit less than 15%, said that there would be no Laffer curve effect. So these people who in the real world deal with actual tax returns and tax planning, they understand the Laffer curve is very, very real.